Welcome everyone to Let's Talk Real Estate Investing. In this series, we chat with real estate investing professionals and experts to empower you to build your personalized real estate investing strategy. Each of us are unique, and so each of us should have a very unique strategy. If you enjoy this podcast, I ask you to hit the like button and subscribe to my channel. When you subscribe, you'll get notifications when a new podcast has been released. My name is Debbie Balfour, if you don't already know, and I'm a real estate investing professional and a real estate investment success coach. I coach real estate investors to build your personalized real estate investing strategy and also build your systems and processes so that you can scale efficiently, so you can start enjoying financial freedom, but most of all, time freedom. That's what we're all doing with that financial freedom. We're all unique, as I mentioned, so let's build that strategy that's unique to you. I'm excited to introduce my special guest today, uh, Kyle Agro from Cobin Wealth. Our topic today is navigating today's macro and microeconomic environments, investing in real estate. Kyle has over a decade's worth of investment experience, with more than half being focused on private investments and real estate. He's dedicated to providing his investors with the right solution that will help them achieve their investments goal. Before we go any further, I'd like Kyle to talk a little bit more about his journey in real estate. Welcome, Kyle.
Hi, Debbie. Great to be here. Thanks for having me on. So, I guess you asked me to give a little bit of introduction to myself. So, why don't I
Yeah,
start there?
please.
So, yeah, my name's Kyle Agro. I'm vice president at Cobin Wealth. We are a full scale real estate investment firm, and we right now are working with Lankin Investments in terms of offering their suite of investments to the public. My journey to how I got here, I guess, is where we should start. First, coming out of college, I worked for one of the top five banks in terms of TD. And from starting there and kind of growing myself from a financial standpoint, really what I was doing was I was working with individuals as a financial coach and putting them really into their proprietary blend of mutual funds is essentially what they do at the banks there. Now, I never really liked doing that, really just because I always had a passion for other asset classes, specifically real estate. I've seen a ton of my friends investing in real estate. I saw them growing their portfolios and their wealth that way. And when you look at it, a mutual fund, it's publicly traded, number one. When you look at something that's publicly traded, really it's at the whims of the stock market, right? It's going up, down, and it really doesn't have any rhyme or reason why it's doing that. And especially in today's world where we're in a specific geopolitical environment and macroeconomic environment. And those two things coming together, I feel like things are more speculative now than they ever have been, especially moving into the digital age as well. So I wasn't really comfortable putting people in these investments where I had no idea what they'd be doing tomorrow. People are trusting me with their retirements, with their lifestyle changes, with putting their kids through school, and I had no idea what was going to happen with it. So I knew I had to do something different. Again, I saw some of the real estate stuff, and that's how I started moving my career in another direction. I started my private equity real estate experience with a company called Equiton Capital, and I really got my feet wet there. They brought me in, they showed me the ropes. I was able to see the differences between the public and the private side, which is something that's extremely important. As I mentioned, public is listed on a stock exchange. So, really, how public mutual funds or public stocks or any of those type of things are valued is based off volume of trading. If somebody buys it, it goes up. If somebody sells it, it goes down. There's no really rhyme or reason behind it. It's more what the public perceives that stock or mutual fund should be worth at any given point in time.
Mm-hmm.
When you look at the private side, it's more balance sheet, income statement, cash flow statement focused. So as long as you're able to move your assets in an upward trajectory and you have strong fundamentals behind it, then it'll always be moving in an upward trajectory. If people buy in or buy out, it doesn't really affect the unit price, which is kind of like a stock price. So
Right.
that was something that
So what is it about the model that Cobin Wealth has that's different to what you've seen before that enticed you to move?
that's a great question. And I think it comes down to being critical thinkers. I think a lot of the products that are out there are very vanilla. They're very cookie cutter. A lot of them are doing the exact same thing. They're just rinsing and repeating and just trying to put their own little spin on something and then call it their own. Where listening to the top guys who are running the show here at Cobin, critical thinking, and they really have extensive experience, and they just don't believe in a cookie cutter formula. I mean, really, what we do is we leverage market conditions and do really extensive due diligence and market research to determine how we can be able to provide returns for our investors and mitigate risk that's associated with any of these type of investments. We offer a very catered solution that's not the shotgun vanilla flavored approach that I was saying. And I think that
Mm-hmm.
makes us different than what's offered in today's market. Really, what we do is we take funds like what they do and we kind of split them out into little pieces. And really, what that does is it gives investors a more focused approach on what they would like to invest in, whether it be a long term cash on cash strategy or a strategy that's more opportunity based, where we're creating a better community for people to live in as well. So we're buying and we're doing renovations and having people be able to live in a better community, be able to feel better about what they're doing, and be able to live there as well. And I feel like by splitting it out, you're not cannibalizing the two investment strategies, because
Mm-hmm.
if you're doing one or the other, they kind of go against each other's philosophies. And I also think that it puts the investor in the driver's seat. Like they're able to have more control over their risk versus reward exposure, which is something that is very unique to what Cobin does, and it's something that I had never seen in the market. And I've been in the industry over 5 years. I've been in the investment space over a decade. So by them, again, leading back to the original thing that I said, being critical thinkers and doing things a little bit different and offering things a little bit different. I think that always leaving the investor in the driver's seat of what they want and the type of returns they want with the exposure that they want to risk is extremely important.
Oh, when we chatted before, you explained to me the model really well in that how others do it, where it's a mixed bag, and how you split out. Can you go in a bit more detail about that? How the the cash part of it. So if you're looking for cash returns versus if you want to invest and wait with funds.
Of course. So typical model is what they're doing is they're buying buildings, and
Mm-hmm.
then over time they're running their renovation model on them. So they typically buy older buildings. Let's back up a little bit. So
Mm-hmm.
the stock for multifamily specifically, and when I say multifamily, I mean large apartment buildings, because these are institutions. It's not like your um, let's call it fiveplexes, sixplexes that I'm talking about. Now, anything over 5 or more units within one structure of a building is considered a multifamily.
Multifamily.
We're doing this, and others in the space are doing this on an institutional level. Now, typically, the model that you're looking at from most of the companies in this industry would be to buy these properties, and then typically they're going to hold them for somewhere between 8 to 10 years. And they're going to run a model where, as you have natural turnover, because all of these companies are trying to do this in a very specific way so that they are helping the communities. That's a big thing for all of these companies as a whole. And I think that that's something that needs to be said, because most of the stock for these large scale multifamilies were built 1960 or before. So
Mm-hmm.
they're dated. Like they need to get updated. They need to look better. And by these companies doing this, we're giving people a better place to live. We're creating better communities. And that's really what that at the end of the day is the number one thing that we're doing, but being responsible about it. And with that, you can increase the overall profitability of your portfolio as a whole based off having these buildings raise in value, because you're running your model on it. Now there's two sides to this though. So typically in Ontario, what we're seeing is roughly 20% turnover rates in these type of buildings. So that's people naturally moving out, right?
Yeah.
That's, I don't know, they moved, different lifestyle, buying a house, whatever it may be. So when that happens, what these companies will do, they'll go in, they'll renovate these units, they'll get new tenants in, right? New tenants in, you bring the rents up to market value, essentially, doing it in a responsible way. And people coming in, they know exactly what they're doing at that point, never raising rent above and beyond that for the people who are already there, so they have a chance to stay. But as you're doing that, you're creating value. The number one way you're creating value is because your income is going to go up because you're increasing the rents.
Right.
Two, as you're increasing those rents, those go to the bottom line because multifamily is looked at as a business rather than real estate. So it's really your income minus revenue.
Right.
So not only are you raising the income, but you're also going to go in and you're going to run your ESG initiative too. You take after the environment and you lower consumption, which lowers costs. So it's just a win-win scenario.
Yeah.
You look
We're
at really
increasing cap rates and then
exactly.
increasing the value.
So you're lowering gas, water, electricity consumption. So if they're consuming less, plus you're getting a little bit more rent out of it because new renters are going in, the overall valuations are going to move in an upward trajectory. And that's where, like you said, where a cap rate comes in,
Yeah.
right? Because that's how, just a measure that they use to determine that at any given point in time.
Yeah.
That's what a cap rate is, right? I like to look at it a little bit different because I like to look at what I call an intrinsic cap rate, because when you're buying a building, it just tells you what it is at that point in time. What it could be worth over time is an intrinsic cap rate. And that's where we come in, because we see where the potential of this building could be.
Right.
And we like the large scale multifamily space because if you look from a land scarcity perspective, they're building out and out and out. But in the GTA specifically, we're running out of land. Above us is the protected green belt. You can't build on it. Below us is the lake. So what that's doing is it's forcing population growth into what we call the urban settlement. We're running out of land there. So instead of going horizontal, we're going vertical at this point.
Yeah.
Now, if you could buy some of these older buildings, they usually start cities here and then they build out. So if you buy some of these larger multifamily buildings that are older, obviously, you're going to be able to get them in prime time location typically, right? Plus, back then, a little bit bigger footprints as well.
Yes, definitely.
It's a little bit more attractive, let's call it, than some of the new stock that's coming online if you're looking for something like that, right? And when you buy these buildings, even when you're getting to, let's call it market rents, these are slightly lower than something of a new build because they're older, right? So it gives that opportunity for not only the investment side, but also the rental side.
Right.
So when you're looking at these, again, two ways that you make money off of this are number one, through the cash flow, and number two, through the value.
Equity.
Okay.
Yeah.
Now, the problem that I found with a lot of companies and what they're doing today is that they're cannibalizing both sides of it. If you're doing both initiatives and you're taking the cash flow that you're making and you're just running it into your renovations, let's call it, then what you're doing is you're taking away from the return that you could give your investors, right? Because so you're cannibalizing the cash to put it into the value of the building, but then it takes 8 to 10 years when you're having regular turnover for you to be able to maximize the efficiencies of the building and maximize the revenue of it over time. So because of that, it's just not producing the returns that it should. And when you look at, especially in trying times like we've seen over the last couple of years, a lot of these funds have struggled immensely because of this. Where here at Lankin specifically, because we're offering Lankin Investments, Cobin is just the wealth management division of Lankin. Let's just get that out there. What we're doing here is we're offering two products rather than one for this specific model. Rather than doing it all as one and cannibalizing it, we have one fund that we call our apartment REIT, which is a long-term play, which we're buying and we're holding them for the foreseeable future. We're not going to sell them. Really what we want to do here is we're buying assets that are coming off of larger institutions' strategies instead of new buildings, which is better from a risk perspective. Because we're buying ones that, like some of the big players like Cap REIT, or RioCan or any of those big players in the game. They'll buy a building, they'll do a bunch of renovations on it because the value of it goes like this, then they'll sell it before it starts going like this. What
Right.
we want to do is we want to buy it right at that inflection point because they're still leaving a lot of money on the table, let's call it, to be made. And as long as you're looking at it from a longer term solution, these can be great for cash flow. So
Right.
within this fund, we're actually offering a projected net return to our investors of somewhere between 14 and 18%, which
That's a
is,
sweet return.
yeah, that's definitely generally a lot higher than what you would see.
Mm-hmm.
Typically, what I've seen from other companies that
The
are
10,
similar in the industry is around the 8 to 10
8 to 10. Yeah.
on something like that, right?
Mm-hmm.
We can go into the particulars of it a little bit more, but in the interest of time, I'll keep it high level for
Yeah. I
these.
just wanted, yeah, let's
Yeah.
just go through the model.
And
Yeah.
then the second side is our opportunity fund. So our opportunity fund is essentially what we're doing is we're buying the buildings um, that are not stabilized at all. So they are very ground level. They haven't been touched in a long time. Let's say at no renovation since the 60s or 80s, whenever they
Mm-hmm.
were built, something like that. And what we're going to do is we're going to go in and we're going to run our model to enhance the overall profitability of that. And that's typically like a 3 to 5 year model within that fund specifically. And then we're going to sell the buildings.
Right.
So one's a buy and hold, one's a buy and sell.
Mm-hmm. And
Okay.
so one's more from my perspective, when I look at it, one is more, sounds more like if you've got registered funds and you just kind of park and forget kind of thing, that one. But if you're looking for cash flow, like if you're using your line of credit, you want, you want regular cash flow, or you've got some cash sitting there, then the other one is, ideal for that, because you can take out that cash and live off of it.
That's correct. I would agree with that. The one thing I would add though is that the opportunity fund, although it's not cash flowing,
Mm-hmm.
because we're putting a lot of money into renovating these buildings,
Mm-hmm.
typically what we're doing is there's no profit to be made until the building's sold, right?
Yes.
So
Yeah.
there's losses essentially in the beginning until you actually sell a building. So we actually flow those losses directly through to our investors so they can write it off against their income in that year. So if you're looking for a tax play as well, that's something that might be of consideration, because if you can take a loss and you're a higher income earner, let's say you're in like that 40 to 53% tax bracket, that's going to add another 4 to 6% of a return in the form of tax write-offs. So depending on what you're doing, I'm an advisor. I'm very ground level. What I do is I educate people. That's what I focus on first and foremost. So
Mm-hmm.
whenever I take anybody in or they want to talk to me, I educate them on everything. I really get a really good feel for who they are, what they're looking for, and what their situation is. And based off of that, I could guide them in the different directions of what we can offer. So I wouldn't necessarily one's better than the other, but definitely
It
if you're looking
depends
for
on the
capital,
person and their situation.
exactly,
And they should
exactly,
talk to an accountant too. They,
of
they
course.
should speak to their accountant when doing
Disclaimer, I'm
this.
not an accountant. I'm not a lawyer. I would always run this stuff through them. I have a lot of experience, so I can guide you in the right direction, but I would always suggest to get professional
Yeah.
opinions before you make any investments in any company, period.
Well, I think this is so unique though, that part, because I've never heard of that before, where you're actually, so okay, you're not getting the equity yet in this, but you're actually able to pull some of that losses in, because usually you don't see it. You don't see it's all in there. You get the money at the end,
Correct.
but the company takes the losses, the actual fund takes the losses, but now you're dividing those losses among your investors so that they can claim it against. And it's all about, so you're not getting money directly, but you're paying less taxes, hence you've got the percent return is even better.
That's exactly it. And that's what I mean by Cobin being critical thinkers. Like they're just
Mm-hmm.
taking what's available to Canadians. They're not doing anything different in a sense of it's the same type of model, but by splitting them up and looking at it from a little bit more granular perspective, we're able to extract value in other ways that most companies just aren't able to do because the structure that they have just doesn't facilitate that.
Yeah. So, yeah, very creative thinking. I think it's
Definitely.
great. So let's get into some of you've mentioned before about macro and microeconomic environment today. So let's talk a bit more about that. What are some of the problems you're seeing within the macro and microeconomic
Let's go back
environment?
just a couple of years because I think that a lot of what we're seeing is because of COVID. Like COVID was obviously a really big thing that happened. It's a once in a century type of event. So I like to use that because I still feel like it's relevant to what's happening today. Although we're getting to the tail end of it, I like to call it the end of the COVID hangover. That's what I call it. And the reason why is this: if you let's go back, let's see what happened, and then let's look at what we're seeing moving into the future. So when COVID came around, what the Bank of Canada did is they lowered interest rates to the lowest that they've ever been because they were scared that this pandemic was going to shut everything down. They thought
Mm-hmm.
it was going to stall the economy. Now, by theory, that makes sense. Lower it down. What that does is it makes it easier for people to borrow, which promotes spending, right?
Yes.
Everybody started spending. We saw housing prices increase. We saw everything really increase. Now, the problem is um, supply shortages. I mean, even just looking outside of real estate as a whole, let's look at what happened with the inflationary environment. Let's look at specifically, I look at the Eastern countries in terms of China, who produces a lot. We couldn't get any of the goods over here because everything shut down.
Mm-hmm.
So when you lower interest rates to promote spending, but then supply chain shortages happen or supply chains halt altogether
Halted.
at
Yeah.
that point in
All
time.
those container ships were sitting out there at sea.
Exactly. Everybody remembers reading that or
Yeah.
seeing it for that matter on the news. But that's a huge problem because now you have major demand and low supply. And what does that do? That's literally macroeconomics 101. This is not rocket science. What that's going to do is it's going to shoot up your inflation. So
Mm-hmm.
now we saw inflation fly up all the way to 9%, like this, right? Like it just
Mm-hmm.
happened. It almost feels like it happened overnight. I mean, there were a lot of tells that were coming, but it didn't really hit hard until the Bank of Canada waiting too long to start raising our interest rates. Now, by waiting too long, they had to go hard and they had to go fast.
Yes.
And then we saw interest rates shoot up the fastest that they have since the early 80s. They didn't go quite as high as they did there, but during my lifetime, that is the highest that we've ever seen interest rates.
Yeah.
Okay. Now you just went like this with supply demand to like this, right? Now there's um, oversupply and not enough demand. And what that does is it starts to really start to lower the demand, but it's lowering inflation. So we saw inflation starting to creep down, creep down, creep down. And it actually, at this point, I think last week, the last one we saw, it was at 1.8%, which is actually lower than the target. So the target that they have is 2%. Now,
Okay.
between 1 and 3 is good, but if it's under 2%, it means that they need to lower interest rates so that they can promote spending. And if it's over 2%, then they need to raise interest rates so that people don't spend. They try and keep that as close to that 2% as possible, but it's obviously a fluctuating number.
Okay.
So, with everything that happened and then um, inflation coming down as fast as it is, the Bank of Canada is forced to start lowering interest rates as fast as possible because now they don't want to stall the economy, right?
Mm-hmm.
So, and that's what we're seeing right now. I mean, we've seen the mega cuts that they've been doing, and they're expecting these to continue well into this year. We don't know exactly what that's going to look like. Stay tuned. Bank of Canada tomorrow actually is their next cut. We're expecting 25 basis points again, but that comes off of the back of a few 50 pointers,
Yeah.
right? So what that's doing is it's starting to make things not necessarily affordable, but it's promoting spending again and being able and people being able to borrow at decent levels again.
And then from a
So
real estate investing perspective, now investors' confidence starts to go up, and then they start buying again.
yeah, but the thing is, like most consumers are a little bit far behind. Like I
Mm-hmm.
like to look at what institutions are doing and I like to look at what financial advisors are doing. And the reason why is because these people are the professionals who's being paid to manage people's money.
Yes.
You're being paid to manage people's money. If you're not making money, you're going to go out of business real quick. So what we're seeing in the institutional space specifically is a lot of institutions are picking up and buying these multifamily assets at a quicker pace. The reason why is because there's always a fine line that you run with these type of funds, or in an individual investor perspective, the same thing, but it's
Mm-hmm.
interest rate versus cost.
Yes.
So right now we feel like the cyclical nature of real estate is coming back around. We've seen the worst of it. We're going to start to see things coming up, and that's based off all that macroeconomic and monetary policy stuff I was just talking about. We should
Mm-hmm.
see people coming back to the table. So now's the time to buy before everybody rushes back in. Once
Well,
everybody rushes back in, then it's too late.
the prices of the
Exactly.
stock
Oh, you're
is,
going here.
yep.
That's the part. When it starts to go like this, that's when you're going to run into problems,
Mm-hmm.
right? Now, from an individual investor perspective, it's running a tight line because you're typically doing traditional mortgages or even secondary mortgages on these assets. So from a condo perspective, we're still seeing that lag there because if you buy a condo and you're closing, if you bought a condo, let's say a pre-con, and it's closing now, you're still at the point where you can't charge as much in rent as what the mortgage is. So if you're not making money, what's the point? That's why these
Yes.
assets are still looked at as the black sheep of the industry right now, and why not a lot of people are going into these type of investments.
Mm-hmm.
But when you're an institution and you can get the CMHC insured mortgages, as well as you can run the MLI Select. Now, I'm not going to go into those. Those are just specific types of mortgages that you can get that are more favorable from a rate and amortization perspective, which is what we are doing specifically. You can get lower rates. So if we're getting those lower rates, and we're looking at closing, some of the buildings that we're closing on more recently are in the low threes in terms of what we're paying for interest rates, which is obviously really good. And you can get these for a discount right now because of the way the market's been. We're seeing a lot of institutions start to get back into the game and start to buy a lot more.
Mm-hmm.
Then I look at financial advisors, and I'm seeing a lot of more financial advisor money come back to real estate. Last year or two, it's been going out the door a lot quicker than it's been coming in. And the
Right.
reason why we're seeing that is because, again, the cyclical nature, when they're buying, when companies like Lankin are buying these assets and we're running our models on them over the next 3, 5, 6, 7, 10 years are when our investors are going to be able to reap the benefits of it. So now's the time to buy and get back in because the economic tailwinds, let's call it, are a lot more prevalent than the headwinds that we're seeing moving
Mm-hmm.
into the future of real estate. Now it's a time to get back in. Again, you never want to buy when it's starting to skyrocket. You always want to buy right
Down
when it's
market. Yeah.
and
Mm-hmm.
real estate is at that point right now, just based off the way things have been and the way things are going at this point.
Yeah. That's good. So, I want to address the elephant in the room talking about real estate and investing. There's a lot of people right now that are now fearful. They were all, real estate is the thing to do. It's much better than stocks, and so they've invested, some people, their life savings into real estate, into private market. And we're seeing a lot of bankruptcies happening now so people are losing their shirts with, private lending and even private equities where they thought that they was secure. Bigger companies too. So there's the little people, but also, there are bigger, well-known companies with syndicated mortgages, etc., that were supposed to be low risk, and now they're not paying back their money. They're going through securities, all these different things. So, can you address how through Cobin Wealth you're able to mitigate some of these strategies and get rid of some of to help people who are fearful and around now, like, I don't want to invest anymore in real estate is privately because I'm going to lose my shirt.
Yeah, I mean, there's a lot of different risks and rewards that you can take within this industry. Number one. Number two, I think people need to realize that real estate is more of a buy and hold strategy than a buy and sell. So you have to be able to keep your head above the water when things aren't 100% what they could be. I really feel like a global pandemic happened. And because of the wave and ripple effect of the things that I just said, it made the real estate market really the lowest that it's been in the last 38 years. right?
Mm-hmm.
Now, if you look at a lot of the um, things that are happening in Canada from an immigration standpoint. Now, I know that the Bank of Canada, sorry, the federal government at this point is saying that they're going to bring in a lot less people, but it's still well above the targets of what they were pre-pandemic. In terms of, we're still looking at about 350 to 400,000 people per year,
Mm-hmm.
and if you look at what they were saying before that, they were saying about 500,000 per year, but they were really bringing in more like 1.2, 1.3 per year. So
Mm-hmm.
when you bring those in, and then we have labor shortages in Canada, skilled trade workers are just not coming in as fast as they're leaving. So because of that, Canada really has only been able to pump out about 174,000 homes per year over the last 10 years. And with the discrepancy that you're seeing there in terms of how many people are coming in versus how much we can build, I think that that's really going to be promoting real estate as a whole. With that being said, there's different things, and you need to take things into consideration when you're looking for an investment in the space. I think having somebody like a Kyle Agro of the world who working for a wealth management firm rather than directly for one of these REITs, let's call it, it will help you out a lot, because really what I want to do is I want to be a financial advisor on the private side, right? I know there's some
Mm-hmm.
EMDs and those type of things, but having exclusive looks to certain products are different, and having us do the major due diligence, et cetera, on people's behalf, that should make them feel a little bit better. With that being said, what does that mean? I mean, number one, having somebody who's just working for one company and trying to sell you something, they're always going to have that company's interest best in mind. When you're able to have an array of different companies on and be able to sell and be able to be a part of their due diligence process, that's going to give you a lot to be, let's call it, to take the risk off that of investors. Number one. Number two, there's different type of asset classes that you can invest in. I think the two that really took the biggest hit were development and um, private loans. And I think that when things go south, those are the two ones that are always going to take the biggest hit. And the reason why is because those ones in my mind are a lot more risky than something like private equity in a multifamily. Multifamily is already built. It's already got a valuation. If anything really bad happens, you could always sell off a building, right?
Mm-hmm.
You can always borrow against these buildings. So because of that, they typically handle the stress of down markets a little bit better.
And you
Now,
have to have the money up front too, and then go back to get, to get that money. So you have to have money ahead of time. It's not like you borrow the money and then do the development with it.
well, usually you get pre-sales. So you sell
Yeah.
60 to 70% of your building, because now you're getting commitment from the end user that they're going to pay the bill at the end.
Yes.
Now, the problem is that's a commitment, right? Now, with that commitment, then that's what the bank wants to see in order to facilitate the construction loan,
Mm-hmm.
right? Or the land loan, or both for that matter. But nothing's actually been paid yet. So when things change and now they can't actually sell and meet those commitments, um, meet like the guidelines so that they can actually build it, then that's when they start to go into receivership, et cetera, et cetera.
Mm-hmm.
Now, that's one thing. The second thing they do is they'll use one project's equity to start financing the next one and the next one and the next one. Now, if something bad happens in there, it's just a domino effect and they all fall. Right now, what I'm seeing, and from some of the companies that I've been around, is even if they do things in the right way, a lot of projects are going to get majorly delayed. Like, the market's not there for the condos yet. It's not coming. It's not going to be coming around. We don't forecast for at least the next 3, 4, 5 years from a development perspective, because there's so much stock on the market right now that has to get absorbed before new things can actually go online. So if investors are invested in developments right now, I think that it's going to be a little bit longer for them to get their money out of it, and that they're not going to be able to make as much money as what the company told them that they're going to. And now that's eroding your returns.
Yes.
So if you had a 5-year project and it was looking like 20% per year, well, I mean, just for ease of numbers, it probably won't go this far. But if it went 10 years, well, now you're only getting a 10 per year. So you just took on a super, super risky asset class in development. And now it's showing why it's so risky, right?
Mm-hmm.
And your money's out the door. It's not even like you could pull it at any point in time.
Yeah.
Developments are like hard holds. You can't pull your money out. You have to wait till the end. You don't get anything at all, essentially, until that happens. So that's where investors are eating their shirts a little bit and where there's a lot of worry to do with development. Then the second thing we were speaking about is private lending. Private lending to me is always higher risk than anything else, really, because rather than it being equity, even in a development project, if the company owns the land, it's still going up in value, et cetera, for the most part. But debt to me is a little bit more risky because it's somebody's ability to pay something back. Now, I know that there's an asset typically that's on it, and there's a lot of different risks, even within private lending, going from first, second, third, or even mezzanine mortgages, et cetera, et cetera. But because of somebody's ability to pay you back and because it's a private mortgage specifically, to me, that makes it higher risk. Because if it wasn't higher risk, then one of the banks would have taken it on and they would have had a regular interest rate. But if you're making 15%, let's say, off of a private loan, what are they actually paying? Because the company's got to make money too, who's able to offer it to you, and the actual lender's making money, right?
Yes.
So if you're making a 15% profit off of that, these people are paying upwards of 20% interest on these loans. Now, I don't know about you, but buying $1 million house or something like that and having a 20% interest rate, that makes me feel sick, even if it is short term. So to
Mm-hmm.
me, that's extremely high risk. And when you see regular interest rates skyrocket to the point where they're almost hitting double digit numbers, and then you have private lending out there, it's just too much for people to be able to take on. And the debts were rising a lot faster than people's incomes, and people were taking on more than what they could chew. And because of that, that's probably the biggest sector that we saw most of the delinquencies happening and a lot of people losing their monies, because people's ability to pay back their debt was just not there.
Yep. Definitely. Because they got involved when money was free.
Exactly. Pretty much. Yeah,
So they were like, oh, look at all this profit. Now money is not free anymore. And now.
Yeah, I bought my house right at the beginning of the pandemic, and the interest rate I got on it was 1.4%, which is insane. So
Sweet.
that's the lowest that I got to see it myself personally. But yeah, it was pretty much free money at that point, right?
Mm-hmm.
So moving into what it is today, I think it'll never go back to the free money, but we're starting to move into um, territory where that's where the new normal is going to stay, which is promoting spending. But looking at why investors have eaten their shirt and why they're probably weary a little bit is a lot to do with what has happened, and the type of investments that they were getting themselves into. Now, when you look at private equity in terms of a multifamily building, again, saying the same things I was saying before, you have a
Mm-hmm.
building, you could sell it, you could refinance it. There's a lot of different things you could do to make sure that this is profitable moving into the future.
And you're already seeing the operating budget. You're already seeing the operating costs. You've got a history there. Well, with new developments, with new things coming in, there are no books. There's no
That's exactly
record
what I
of
mean. And then by
history.
working with somebody like a Cobin, you can pick the risk level. Like
Mhm.
if you want as low of risk as possible, go in our apartment REIT, because that one is already cash flow positive from day one. It's not a strategy where it's renovate to extract the value out of the building, right?
Mm-hmm.
It's something that's already in place. We're using different, let's call it, financing tactics, as well as a specific strategy that we have of buying them, let's call it 80% stabilized, and still getting a little bit out of it when we are having that regular turn, but we're not banking on that. Even if nothing happens, it's still making money.
Yeah.
So that's a really low risk. And then you can move into something like an opportunity fund, which is some of those funds that are focused more on buying the old stock and then bringing it up to date. Now, they're doing great things for the people who live there. They're doing great things for the environment. But that, in my mind, is a slightly higher risk model because you're banking on spending money to make money, right?
Mm-hmm.
So, but it's a little bit higher, but it's not, it's again, you still own a building that's worth money, right? So that's a lot lower risk than something like a new development or something like private lending, which is more focused on things that are not in your control.
Right. Yeah, definitely. Awesome. Thanks so much, Kyle. I always ask my speakers if you've got a freebie offer for the audience. Is there something you'd like to offer free?
Yeah, I mean, a free conversation. Again, I'm super educational. I've spent a ton of time in the space. So if anybody just wants to pick my brain on anything that they have going on, or they want to hear about some of the opportunities that are in the market that isn't necessarily common knowledge, feel free to reach out to Debbie, and she'll get you in contact with me. And we can have a educational introductory type of call, so I can just answer any questions that you guys have.
And I will put into this video, so it will be on the screen in this video, your contact information so that they can get in touch with you, Kyle. Awesome. So thank you so much for your time. I really appreciate it. For everyone, if you enjoy this podcast, please hit the like button and subscribe, and keep joining us. I really appreciate it. Also, if you'd like to be a guest speaker, I interview guest speakers both from experts like Kyle himself that support real estate investors. So if you're an expert that's, in your portfolio of clients are real estate investors, I'd love to talk to you. Or if you're a real estate investor, you don't have to be one that's been doing it for 20 years. You could be just started and there's something that you're passionate, something that you're doing differently, maybe even your mindset. So I'd love to interview you, get everybody out there. I'd love to share your stories and also build up everyone's credibility. So thanks so much, Kyle. I really appreciate it, and have a wonderful day.